Huge thanks to our sponsors that allow all of this to happen. So I want to move quickly on to our next session. And this is an opportunity for you to get involved as well. I want to take some of your questions here because we're going to talk about what that new world order looks like. Because for India to be the second largest economy by 2050, it needs work, the structural reforms, digital transformation, a shift as we've seen in global trade and investment. So I want to bring together some leading experts in that field to talk about exactly that. So please let me welcome to the stage Sanjay Nayar, who's the founder and chairman of Sorin Investments, Vineet Rai, who's the founder and vice chairman of Aavishkaar Group, Manish Jain, chief strategy officer, director of capital markets at Mirae Asset Capital Markets, and also Amit Ramchandani, who's the chief executive of head of investment banking at Motilal Oswal Investment Advisors, and lastly Dilip Kadambi, who's the group chief financial officer at IHH Healthcare. Please take a seat, gentlemen. Come on, I'm going to stay here because I'm going to wander around and take some of your questions in a minute. But gentlemen, please make your way up here and we will begin. Apologies, we are running a little late. There's been a lot for us to fit in. Please, I'm going to stay here.
Having tea and coffee. You call them in.
Good. Yeah, there's people having tea and coffee. They can come back through. We're very relaxed here. Gentlemen, good afternoon to you all. It is just past midday. Thank you for being here. There's so much for us to talk about. And I should just say, I want your questions from the room. So if you have a question, stick your hand up and I will come and find you with a microphone. I've got plenty, but I feel like we've done all the work this morning. So I'm going to hand it over to you because there's so much for us to talk about. But let me kick it off first of all. And I want to take an initial response from each of you on this if I can. You know, we've talked a lot about what the last few days have delivered, what those tariffs mean, what they mean for global economic uncertainty. I wonder how investors, with an eye on India, can adapt to this new world order. Sanjay, maybe let me start with you. How can investors adapt to this new world order?
I think a lot depends. Is it on?
Yeah, there we go.
I think it depends what kind of investor you're referring to. I'm not going to talk about stock market investors, but in terms of foreign direct investors, huge opportunity, what this whole thing represents. But I think first, Ben, we should just focus on what it means for India.
I don't think your microphone
is it coming.
I'm going to give you this. Excuse me.
I think first and foremost, you've got to think about what it means for India, what's going on. And I think at least my narrative is a little different than what I've been hearing for last 72 hours. I think India is going to be impacted, moderately though. 18% of our exports, merchandise exports, are to the US, and there is no way that we are going to escape unscathed. I think a lot will depend on how the private sector adapts to the change that's coming. A lot will depend how government can speed up the structural reforms. They've done a lot already, but there are a few things that are pending, need to be really put on the drawing board and executed, whether it's judicial, contract, labor. Both sides have done a lot already. Okay, let's face it. Our Indian companies have built scale. They have a certain degree of product differentiation. They've done a good job on exports. Government has done a lot on investing in digital, physical, and social infrastructure. But I think that the time for kind of hiding behind tariffs is over. Okay, and I think the private sector will have to just reset entirely their supply chains, diversify their markets, build bigger and more efficient businesses, be more comply with sustainability norms if they want to get into exports and diversify the export base. So having said that, I think that's where the opportunity is there for investors. Yeah. Foreign investors coming into India will come when these things fall in place and it's easy to set up capacity. You have the skilled labor for the right areas. I don't want to use the word ease of doing business. I think we have come a long way. But more than that, India should present for the foreign investor a real place to come up and put up a manufacturing business to be able to plug itself into the supply chain. So that's been talked about a lot, but the reality will happen when the Indian businesses and the Indian public sector really get their act together. And I think this is a call to action. This is frankly a call to action. We shouldn't take it lightly. It's a massive opportunity, like the Chief Minister just said. But it's not just going to happen by assuming that we have an advantage. Okay, we'll have to translate the advantage to reality.
Vineet, I'm interested there. You know, we hear about what could happen. What needs to change to allow that to happen?
I think let me start by first confessing I have no idea what will happen over the next 6 months.
Nobody can hear you. We can...
I'm a born Hindu, and within the Hindu, this thing we have a trinity, Brahma, Vishnu, Mahesh. So US pretty much created the China story, then nurtured it for 50 years, and we are now at a stage where Trump is actually reflecting the Mahesh role, which is destruction of the world order. Now, every destruction of the world order, we generally believe that a new order will emerge, and that new order is what we are all trying to angle to. From my vantage point, what I see is everybody will rush to dollar in the interim because that's the safest thing that people know of. Whether it will remain safe or not, because based on what the US thought process is, they want to weaken the dollar. But at this point of time, it seems capital is going to look for safe haven, and dollar seems to be the reserve currency and therefore the safe haven in the interim. I don't expect much investment movement to happen. Capital is going to go towards US. And those who are actually depending on foreign capital will struggle. People like us also who raise 50% of our capital globally will suffer. However, I come from an impact investing background. We invest for inclusive India or inclusive South Asia, inclusive Africa. I actually see in the USAID folding up a new potential opportunity for those who are working on inclusion, because I see that $50 billion rerouting itself through DFC and the check sizes, because India, for the great leadership that the Prime Minister has shown, we have not been humiliated as much as the rest of the world has been. And I therefore see India standing on the right side of that new money coming in, more coming in as investment rather than as philanthropy. It would mean a fairly challenging world for Africa, but for India it means we might actually get dollars where philanthropic capital is re-coming in at softer prices. Softer dollar prices, but 5 to 6% dollar is not bad. Which is where DFC comes in at a pricing. So I see there are great opportunities that will emerge, especially for the inclusive part of India. And I personally believe that where we stand and what we are seeing, the great opportunity for us emerges in the food security issues that the world is facing. We have forgotten about Ukraine, but the Black Sea blockade pretty much had no food, no bread in Europe. I think there is a new rush that is going on for securing the food supply, whether it is Middle East or Europe. And I think India's farmer has a great opportunity emerging. So those who are looking at agri-tech may not have seen it as the most exciting field till now, but over the next 5 years, it might actually be a very exciting field given the food security issues in a more deglobalizing world.
Yeah, and Amit, let me ask you that. Where are the opportunities here? I mean, we need to talk about the risks clearly, but I don't think the dust has settled enough yet on what we've seen from the White House in terms of working out where is most vulnerable. But I wonder, maybe if you've got a sense of where is vulnerable, but where those opportunities may be as India pivots.
So, in terms of sectors, I think, while domestic consumption is going to continue and lead from the front, and there are some specific sectors like healthcare, and we have Dilip here, he'll probably talk more about it, but domestic infra is where we are seeing huge opportunity. We are seeing opportunities in retail. We are also seeing some big opportunities coming in industrials, which are primarily targeted towards domestic. I think a lot of these companies are looking to raise capital, while all of us talk about huge FII outflows, at least in public markets. For the last 5 years, these outflows have continued to be there, right? It's not a new phenomenon. All of us for the last 20 years at some point thought that there should be some decoupling, and for the last 5 years, that decoupling has actually come through, right? Even in the first 3 months of the year, we've seen about 1.5 lakh crores of FII capital go out, right? And about 2 lakh crores of domestic investments that have happened within the country. So we are seeing, and all of us are new to this, right? We actually at Motilal call equities an eighth wonder, right? Difficult to understand, but the world order is changing, and I think India is going to be at the forefront. Today, there are two kinds of economies, one that are growing well, right? And the other ones that have size. India is probably the only one which has both. It's growing and with size. So we cannot be ignored. While there are setbacks in terms of tariffs, right? we believe that because majority of our exports are more on services side, and pharma will probably be impacted much lesser than other nations, and there will be huge opportunities for us to continue to lead and build new relationships with developed countries.
Yeah. Dilip, Amit mentions healthcare there. I mean, that's your field, isn't it? You've got about $1 billion invested in India. Sum up for me, what do you see India as an investment place? What is the opportunity it presents for you? Because you're investing all over the world, aren't you? But talk to me first of all about India.
So, it's a very interesting question. And if you look at India, the data tells you, you look at the middle class population, you've got over 500 million middle class population within the bracket of 5 lakhs to 30 lakhs income range. You've got insurance growing at over 20 to 25%, healthcare insurance growing at 20 to 25% CAGR. On the other hand, from a demand perspective, if you look at OECD versus India, from a bed to population ratio, we are probably at 1/5 of where OECD countries are. So there is demand, inherent demand in the healthcare market as well. And overall, to top it all, if you look at disease pattern, the disease pattern is changing as well. It's no more the cough and colds, but it's more oncology, more cardiology, more orthopedic, so on and so forth, right? So the disease pattern is changing as well. So there's a huge opportunity in India, and as you rightly mentioned, we currently have 33 hospitals, 5,000 over beds, and between Gleneagles and Fortis, and we are in the process of actually almost doubling that capacity over the next, I would say, 6 to 7 years. So we see an opportunity, and we definitely love to invest more in the country.
Yeah, Manish, it's interesting here, isn't it? Because I was talking there to Ashish at the NC about, some have been real success stories about investment into India, but we've also seen at the same time a lot of FIIs leaving. I wonder whether the worst is over. Maybe talk to me about why that's happening, but whether the worst is over right now.
So I think Amit touched upon the statistics that in last 5 years, we have seen FPI selling to about 80 billion from India. And first 3 months, we have seen about $18 billion getting out. It's a FPI net sell. If we look at the way US administration has behaved, I always assumed that they will start with the worst and things will start softening as we go along. But in between you will have this retaliation and things will take its own time to settle down. Now, from the perspective whether the worst is over or not, you need to look at from the let me bring stock market into perspective here, because that's where they are involved. Time and price wise, if we look at we are in the 6th month of correction. From top, we have corrected 16% so far. So this correction, I would say, is a PE contraction because we were kind of overvalued. And now, people may say that we have come back to the mean. EPS correction is frankly yet to start because we have not really factored in the slowdown and the cut in the EPS. If we look at the history, the EPS correction had been to the tune of 30% in the next 2 to 3 quarters in the past incidences, where we have just cut only 7% so far. And also, even though some of the companies may not have the EPS cut, when the fall happens, even the strong EPS companies are not spared. Yeah. So that's from the price perspective. But if we look at from the timing perspective, COVID peak, trough, and back to the peak was 10 months. GFC was like, it took 10 months to form a bottom. 5 months, we kind of struggled at the bottom and then took another 5-6 years to shoot back to the top. So both from the timing perspective and both from the pricing perspective, I don't think the worst is over.
It's a really interesting point, particularly around timings. I'm aware we don't have loads of time, so does anyone have a question? I know we're on out. Please stick your hand up if you do. I've got loads, but if you have a question for any of our panelists, please don't be shy. Put your hand up and I will bring a microphone to you. Everyone's being very polite. Please stick your hand up if you've got a question, and I will come out. But Sanjay, let me talk to you about that issue of timings, though, because, you know, we look at what's happening right now, and it has all happened. The world order has been rewritten in less than sort of 2 or 3 days. How long does it take for the dust to settle here till we've all got a real grip on what's happening and how we might respond to that?
I mean, I don't know when the dust will settle. I think, as someone mentioned, there's going to be a lot more knee-jerk reactions coming from the US. There are going to be a few reciprocal tariffs going against them, which we already saw one of them. I really don't know. I'm not an expert on how the US admin is thinking about this, but I think one thing is real, that tariffs are going to come, and tariffs are there.
But we know no one wins in a tariff. In a trade war, no one wins. Do they?
Sorry?
In a trade war, no one wins. The consumer ultimately is the person who loses out.
Look, again, I mean, you know, sorry, back to the earlier point. I think we have to think about just our own country, frankly. And I think this is an opportunity if you take it constructively. We have already been, we as in the government has been actually quite smart about signing up FTAs. 1.5 years ago, Ben, I mean, if you look at the UAE, Australia, the EFTA, and now hopefully actively looking at the EU. So we're already kind of laying the foundation to make sure that the backlash on us would be minimal. And also in a world that was anyway becoming more insular, we are creating our own trading highways, right?
Yeah.
So it depends how, so I think the government is doing a really good job on that. There is, don't forget one thing, I think the colleagues already mentioned, the biggest thing that matters to us is not when it goes away or dies down. We have a massive Indian economy. Okay, so we have a buffer and an insulation if we make sure the Indian consumption and Indian investment spending by the private sector, by the government sector, and hopefully consumption comes back. That is the biggest insulation we have while we re-adapt to new supply chains, diversify the export markets, leverage the FTAs. This will all take time. I think 1 year is at the minimum, okay? I, again, am not an expert on the markets like my colleagues here, and I frankly think India is still quite pricey, but that'll be a controversial statement to make. Because the I mean, our private sector, let's face it, is gotten used to using the tax shields not as a private investment incentive, okay? We're so focused on creating, I don't know how to put it, but basically, our private sector today is very focused on return on capital, and they should be. I'm not saying that, okay? But at the same time, you've got to invest in skilling, R&D, you've got to invest in depth, not just scale, and you heard that from our minister earlier. But unless the private sector also steps up, leverages what we have going for us, the PLI, the Make in India programs, the FTA corridors being set up, the investment corridors being set up, that's how we will buffer the impact whenever it dies down. And in the meantime, you have a huge Indian economy. So I think we've got to look at it this way, but it's not going to come by, like I said earlier, assuming that we have a competitive advantage because Vietnam and Bangladesh got hit harder than us. That's a pretty bad way of looking at things, okay?
Yeah, and Amit, maybe let me pick you up on that. You know, you're nodding along there, and you know, it's about the private sector taking on more of the responsibility about what happens in future. You know, that shift away maybe from some public spending and the private involvement. Is that happening? Is there enough of that? Yeah, either of you. Yeah.
I didn't hear you.
So the question being, you know, is the private sector willing to step up to the plate here? Because Sanjay's there talking about some of the challenges that, you know, face, you know, the economy and business. It's about maybe looking a bit more inward looking, making sure that skills are right, the investment's right, that people are in the right place with the right skills at the right time. Is that happening?
So I think the way to look at it, let's actually, the tariff is newsworthy. It's a very big statement. US has imposed tariff. But if you carefully look at India's total exports to US will be somewhere around 200 billion, 110, $20 billion of software, which is outside the tariff, and another 75 billion, so around 200 billion, roughly around 5% of our GDP in terms of. Now, you look at the rest of the economy, it's all local. And whether the private sector is willing to step up or not is actually true for us, irrespective of whether the tariffs come or not.
Yeah.
And this debate and discussion has actually been on for some time as to is the private sector investing cycling is coming through, because the government has been investing in the ports and infrastructure quite significantly. I think there is time for us, and there are two ways to look at it. I think, as Sanjay mentioned, there is actually an economy as is, and there is a disruptive economy that we have not been participating to the extent. And we actually have that startup Mahakumbh just last week. And one of the big debates which has come out of it is, are we investing to disrupt the future, not just for us, but for the world? And that's really where the big question is coming. So for that requires a very different thought process. Just to give you an idea, ChatGPT, it was not created without hundreds of billions going there. Today, even today, we asked this question to Sam Altman that, can India with $10 million, Indian guys and $10 million, can we disrupt ChatGPT? Answer is potentially, but we do not then offer a security for our young entrepreneurs to actually imagine building a business that goes beyond. Yeah. And I think that's really where the quantum and size of our capital has to change. Just to give you an idea, cell manufacturing, to create a 2 gigawatt factory in China, just one company requires $1 billion investment. And this is a challenge for us, for the government, for all of us sitting here. Our fund of fund, the government sovereign fund of fund is $2 billion right now. So that's actually the distinction between us and what is happening in the world. And for us to actually become the second largest economy, the quantum of capital has to significantly change, way beyond anything we can at this point of time imagine. We have to also not forget China is what it is today, because it grew at 10%, and we have yet not hit 10% even once. Yeah. So I think there are challenges. The private sector probably should see this as an opportunity. This tariff war is probably sending a message to India that stable government, 7% growth rate is potentially not good enough for us to actually become where we want to be. Yeah. And that message has to go hard and clear to all our leadership.
And I wonder how it changes, what India does, and maybe it's a question for you, Amit, because, Ashish Chauhan was saying that the tariffs clearly only apply to products, goods, not services. And that structural shift, and applicable in India, but as the economy, a growing part of a bigger part of the economy becomes about services, is India ready for that transformation?
Sorry, I didn't get the question.
Is India ready for that transformation, maybe moving away from manufacturing towards services that, as we know, are not yet subject to tariff?
Sure. No, so I think India is ready for it. If you look at our balance sheets, of corporate balance sheets, we are probably, in best of health. A lot of corporates have raised money to deleverage. In fact, last year, I think we saw almost 2 times the qualified institutional placements that the country did in 2023 versus 2024, right? And the amount raised was 1,30,000 crores, right? Which is massive. So there's a lot of desire to do primary investments. I think most of it, the sectors where we have seen this happen, EMS, defense, infrastructure, right? Renewables. So a lot of these sectors are seeing huge amount of primary go in. The circulation of money is better. We at Motilal believe that this is probably going to be the year where NBFCs are going to do extremely well. The growth is going to be back. Some of the spending power is going to be back. And with all the focus, right, especially government trying to, put money back in hands of consumer, right, through tax ESOPs. So that trillion of, that trillion is going to come back in spending, which is going to see a lot of, entrepreneurs put up their primary capital expenditure and go probably a bit more aggressive on expansion than they have in the past. Yeah. So while it'll take some time for that change to happen, but very, very bullish on the domestic story itself.
Yeah, Dilip and Manish, I want a thought from both of you before we finish. But Dilip, there'll be a lot of people looking around the world right now and thinking, look, where do I put my money? I need to do something. Talk to me about the risks. Because people might be trying to make decisions quite quickly. For your business, what are the risks when it comes, and how do you mitigate some of those?
So, I think if you look at healthcare, the biggest risk I would say is it's not about demand. As I said, demand is there, right? But how do I serve the demand, right? I need clinicians, I need nursing staff, and I need to build capacity, building more hospitals, building more beds.
And do you have that? Can you get that?
So there is an execution risk. It takes time to build a hospital. It's a very complex facility with very complex engineering, so it takes time to build it. And ramp up of capacity is a big risk. I may think that I want to build 1,000 bedder, let's say, in 3 years' time, but because of the very nature of the building, the approvals, etc., it can take more than sometimes 3 years to build a facility. So I would say execution is a big risk, mainly both in terms of the physical infrastructure and the software, in terms of clinicians and clinical staff.
Yeah. And Manish, a final thought from you, if I can, in terms of what India's story has been and the branding of India around the world when it comes to foreign investment. That story has been told, that picture is painted, that message is out there. And I wonder what we've seen in the past few days, whether that story needs to be tweaked somewhat, whether the brand of what India stands for is different now.
No, I think, it's all over same again and again, and that's the famous dialogue from the movie Margin Call. So we have seen this happening in the past, and today, the panelists and we have heard about a lot of statistics which coming out that how India will be able to come out of this relatively unscathed. So from that perspective, I don't think we really need to worry too much about the India story. You look at all the fundamental parameters, whether it is the GDP, the import-export balance, whether the high-frequency indicators, all seem to be doing very well. And we are one of the highest, growing economy in the world. So, frankly, you don't really have to do any rebranding. And the markets, when it rebounds, we have seen in the past that when the inflection points come, and I'm not going into the technical and fundamental details of the inflection points, at the time of GFC, India market rebounded 80% in a year. During COVID, we rebounded 35-40% in a year. So if you're out from this market, then you will really repent. And a time will come when, if FPIs have to hide, they have to come back to India. So I don't think there is any change in the India story for the FPIs, and there would come a point when you will have to come back to India.
Yeah, it's a really important point. Right, I did promise some questions from the floor, so show of hands for a question. There was a gentleman over here. Let me run over here, because you've got a great lineup of speakers, so we might as well hear from them, and you can ask what you want. Let me come over to you. Excuse us. Sorry. There you go. I'll hold it. You're okay. Just explain who you are, and please make it a question, not a statement.
Okay. Myself, Sumit Pokharna. Just wanted to see the past track of Indian markets, or global markets rather. We have seen 2008, then 2011, 2020. The villains may be different every time, and this time also. So, we have seen a sharp correction, and finally the hero which turned up is the liquidity, which supported the global markets. And is this the same thing which is going to happen this time? Because 2008 again, subprime liquidity infused market zoomed up. 11, 20, again the same thing is happening this time. So at one end, tariff war is there, but at the same time, Trump is saying that he is asking Fed to look for interest rates and other things. So is the same picture will be repeated this time also? Yeah.
Who for? Any other panel? Anyone want to jump in? Thank you for your question. Any more? Please show your hands while we answer that question.
Being a clairvoyant right now is a very dangerous business. Avoid trying to predict the future for some time. Wait and watch. Just one last statement. Henry Kissinger once said, making an enemy of America is not very good, but being the friend of America is worse. Trump is just proving that to everyone.
Any more questions? Everyone's being so polite. There's a gentleman. Two more over here. Right, good. Just say where you're from and please make it a question.
Hello, I'm Venkatesh from Punjab National Bank. We last calendar year we saw a record number of primary market issuances by the companies, and many SME IPOs and many corporates had raised funds through the primary market. But over a period of past 3 months, we are seeing a very not much of a gung ho towards the primary market. So where we see this situation will be a bit conducive, and more people, corporates will be raising funds in the primary market.
Sure. So I think it takes time for promoters as well as companies to adjust to the valuation gap. All of us have seen markets come down by about 15-20%, right? When these offerings were filed, and there are a whole lot of them, about 150 odd documents that are lying with SEBI today, right? They were filed with certain expectation of valuation. Because of markets coming down, the valuations have come down, but not all promoters want to go ahead and dilute at these prices because they are very confident of future, right? Whoever has decided to be flexible on valuation has still got that demand, right? SEBI about 2 years back did a small change in regulation which enabled retail participants to be at least 50% of the offering. Now that is retail money building India in a way, right? So and in the last 2 odd years, you've seen a lot of retail investors benefit from this cycle. There is no reason for us to believe that you will not see offerings come through. We believe that starting May, June, you will see a whole lot of primary offerings coming back to market. SME, of course, will be impacted because one has seen the maximum amount of loss in small caps, but large caps and mid caps will continue to raise money, and you will see a whole lot of offering coming out of the digital space, out of the financial space, which have relatively been quieter. Typically you see 40% of raisings in a particular year coming from financials. Last year it was less than 20%. So this year you should see a whole lot of that coming back to markets.
Thank you.
I'll add one more thing here that, don't look at what happened in last 3 months. Take a big picture call that today you are a 4 trillion economy, and at some point in time you have to become 10 trillion economy, maybe in 7, 8 years, 9 years, the kind of projections government has given. Now, if you look at the number of issuances and the total money raised from the IPO market in last 3 years, and convert that as a percentage of GDP, and when you have this incremental GDP getting added in 7, 8 years, which could be to the tune of $7 to $8 trillion, and then you calculate the incremental percentage towards that, that's the kind of capital market potential we are talking about in next 7 to 8 years. So this cyclicality will keep coming into the markets. Every 2, 3, 4 years you have this ups and downs, but the larger picture of the capital market in India really remains intact for a very long time frame.
Thank you. And a final question just down here.
Hi, I'm Ankur from RBI. So considering the knee-jerk reactions that the market is witnessing these days, what are your thoughts on long-term value creation, and will that be a possible factor in terms of lowering some sort of volatility? And whether this is being considered by the industry and by the investors as well?
Thank you.
I think the long-term story doesn't change with short-term shocks. So the short-term shocks create short-term this thing, but there will be a re-architecting of global markets, and the world will be multipolar than unipolar that it has been, or bipolar if one wants to see it that way. It will be multipolar, and there will be a complete new architecture that will emerge. I think while we have focused a lot on the tariffs that have come from US, there is also all the free trade agreements being negotiated. We have been negotiating with the European Union for 4 years now. I think this year will conclude, because now the interest is from both sides. I think there is a re-architecting going on. It's largely going to be influencing the interim, but the long-term story for India remains intact.
Thank you. And a final question.
Hi, this is for the whole panel. They say that you buy when there's blood on the street. So have you yourself invested, or do you think there's more downward potential or maybe sideways action to the current situation?
Thank you. Good question.
No, so see, if you look at markets broadly, right, while large caps are trading at about 19 times, which is, on an average lower by about 5% from the long-term averages. Small caps are trading at 40-45% premium, right? So one can always talk about broader markets, but the real investing happens in stock-specific, situations, and we always believe there is some value to be picked up there, and our suggestion is markets will never give you a one-time opportunity to invest. So please keep deploying as and when you get opportunities, and stagger it over a period of time to get the best returns.
Gentlemen, thank you. I've totally busted time. I'm so sorry, but I wanted to get in some of your questions, so it's not just all about what we are asking. Thank you so much. I know people will come and find you afterwards to talk to you as well. This, as we always say, just the shop window of their expertise. So Sanjay, Vineet, Manish, Amit, and Dilip, thank you so much. Thank you for being with us.
Thank you.
Thank you, gents.